Okay, so is there an actual secret to getting rich? It really is the ultimate financial question. We look around, we see people driving luxury cars, retiring a decade early, building these massive portfolios, and it is incredibly easy to just assume they got lucky, right? We tend to look at wealth like it's a lottery ticket, like this magical stroke of good fortune that only strikes a chosen few. But the reality? Wealth is a highly achievable, step-by-step, systematic process. It's really not about magic at all, it's about mechanics. Okay, let's dive into this. Welcome to this explainer on the Wealth Blueprint. Today, we're jumping straight into the step-by-step realities of building long-term wealth. If you've been looking for a highly structured, no-nonsense path to making your first million, you are in exactly the right place. We're going to break down the exact strategies that transform an totally average income into extraordinary wealth. To do this, we're going to follow a really clear three pillars framework. First, maximizing your earning potential. Second, the art of saving. And third, investing for the future. Basically, we're tracking the complete journey of a single dollar, from the moment you earn it, to keeping it, to finally growing it. Now, we're grounding our entire framework today in some brilliant insight from financial coach Jenna Rose Finney. She emphasizes that we need to build practical, sustainable systems through a clear and judgment-free approach. I love this because it proves that getting rich requires structure, not luck. It just strips away all the guesswork and replaces it with a solid blueprint. All right, let's get into pillar number one, maximizing your earning potential, or bringing the dollar in. And this brilliantly illustrates how your odds of getting rich dramatically increase if you target specific lucrative fields. I mean, look at this. Doctors and surgeons can pull in a cool $200,000 or more every year. Engineers in gas and oil, they often make upwards of $135,000. Lawyers top out just above $130,000, while IT managers and software engineers sit really comfortably around $125,000. The field you choose literally sets your entire financial foundation. But, once you're actually in a career, proactive growth is key. You can't just sit back. Start by seeking out extra education, training, or maybe a mentor to boost your baseline value. Then take that track record of success and explicitly ask for a raise. Seriously, you have to actively ask for what you deserve. To diversify your income even more, start a side hustle. And finally, never be afraid to jump ship. Changing employers is often the absolute fastest way to bump up your pay and grab some fresh experience. Moving right along to pillar number two, the art of saving, keeping your dollar. So the crucial point is, a sky-high salary honestly doesn't mean a thing if you allow every single dollar you earn to immediately escape your wallet. Here is your golden, non-negotiable rule. Every time you get paid, calculate 15 to 20% of your annual gross income and put it straight into savings, and do not touch it. Well, 15% is a solid minimum. Pushing that goal to 20%, that builds the true bedrock of getting rich. But to hit that 20% consistently, you need total visibility. You've got to meticulously track your expenses using budgeting apps like Mint or EveryDollar. If you record every single cent that goes in and out of your wallet for just 3 months, I promise you, you will identify exactly where your money is quietly draining away. It is literally like turning on the floodlights in a pitch-black room. And when you do turn on those lights, well, it can be a painful reality check. You uncover numbers like $1,460. This is what's known in the finance world as the latte factor. A seemingly harmless $4 daily purchase for designer coffee balloons into this massive annual expense. Think about it. $28 a week feels like nothing, but over a year, it's nearly $1,500. Saving a few bucks here and there absolutely makes a huge difference. You also have to steer clear of massive financial black holes. Like buying a brand new, depreciating $50,000 car. In just 5 years, it loses half its value. No way around it, that is $25,000 just vanishing into thin air. Compare that to a reliable used car that gets you from point A to point B perfectly fine. It serves the exact same purpose, but it's a deeply pragmatic and financially efficient choice. You really have to separate smart spending from frivolous luxury. Now, shielding your money requires some pretty unglamorous but highly effective behavioral tweaks. First, make paying off debt your absolute top priority. Debt drains your wealth just as fast as you make it. Try switching to cash to curb that plastic-induced spending spree. If you've got a massive 30-year mortgage, definitely look into refinancing to a 15-year term so you pay less in interest. And above all, resist lifestyle inflation. If you live in a perfectly great apartment, don't just upgrade because your income grows. A modest lifestyle is your ultimate shield. Finally, pillar number 3, investing for the future, multiplying your dollar. Let's move to and see how this builds. This is the exciting phase where your money finally stops sitting idle, rolls up its sleeves, and starts working for you. A Roth IRA is a retirement plan where you can contribute up to $5,500 annually. Because this money is taxed before you put it in, the compound interest it gathers over the years is entirely tax-free. So when you hit retirement, you pull out massive amounts of money without giving a single cent back to the IRS. It's an absolutely crucial tool for tax-free wealth accumulation. Next up is the 401k, specifically when your employer offers matching contributions. Listen, I cannot emphasize this heavily enough. An employer match is the closest thing to literal free money you will ever find in the financial world. You must fully utilize it. Between an IRA, a 401k, and your other investments, you're making sure you aren't relying entirely on something unpredictable like Social Security. Now, when it comes to the stock market itself, we need to remove the intimidation factor right now. If you're just starting out, index funds are your best friend. They are low-fee investments offering relatively safe, broad exposure to the entire market. But a quick warning here, try to avoid the whole allure of day trading. Buying and selling dozens of stocks every single day is basically a fast track to losing your hard-earned money rather than growing it. Keep it simple and stay patient. To really understand the power of that patient investing, take a look at this number, $70,000. If you build up a $1 million portfolio, a reliable 7% return generates $70,000 of passive income every single year. Literally, that's money you earn while you're asleep. That is the true aha moment of building long-term wealth. But you shouldn't put all your eggs in one basket. You need vital portfolio diversification across stocks, bonds, and stable, tangible assets like real estate. Historically, real estate just keeps appreciating in value. For example, owning an apartment in a place like Manhattan, that adds an incredible layer of tangible stability to your overall wealth profile, and hey, you can even rent it out for some extra cash flow. And remember, your strategy has to evolve over time. When you're young, you can afford to take on a bit more investment risk because you have the time to bounce back from any losses. But as you get older, you want to shift to more conservative assets to actively protect the fortune you've built. And look, if at any point this whole shebang feels overwhelming, expert help is always an option. Don't hesitate to use a financial advisor to help make sense of your plan. So we've covered the mechanics. You now know exactly how to bring the dollar in, how to keep it, and how to multiply it. You have the blueprint right in front of you, and the mystery is totally gone. Which leaves us with just one final question. What are you going to do with your next paycheck? Start making your systematic plan today, and I'll catch you in the next explainer.